Hello and welcome to Fund in Focus. I'm Sarah Allen and today I'm speaking with Andrew Swan. We're going to be discussing the Man GLG Asia Opportunities Fund. Andrew, welcome.
Good afternoon.
So to begin with, would you be able to give me an overview of the fund?
Sure. So the fund invests in the Asia ex-Japan universe, and the objective of the fund is to deliver, let's say, rolling 12-month returns in excess of that index, regardless of what's happening in Asia. We have an ability to allocate freely across countries, sectors, but also style factors, importantly. So we have flexibility around that. I think if you look at what drives those returns, the risk and the returns versus the benchmark, we're mostly what we call stock specific or idiosyncratic risk. So it's what's happening at the company level, which is really what's driving the returns relative to the index. There is a little bit of risk and a little bit of return that comes from those country or top-down considerations like style and industry, and we have flexibility around that. So we really are trying to generate excess returns through the cycle regardless of what's going on. It is a volatile part of the world. Asset allocation can play a pretty key role. We do try to get some help from that, but at the end of the day, it's really what's happening at the company level, which is where we're trying to get our excess returns from.
What is the case for investing in Asian equities in the current environment?
There's a number of positives. There's also obviously negatives as well. Overall, I'd say the outlook is on balance, looking interesting right now. I guess there's three key things which I would focus on at this point in time. Firstly, technology, where technology industry is up to, particularly around artificial intelligence. The development of artificial intelligence is actually quite a significant positive for some of the big companies in Asia and also the big industries in Asia, particularly around semiconductors. A lot of the stuff which drives, let's say, some of the big US chip companies is all manufactured in Asia. And as artificial intelligence moves from just being in servers and training new models, it's going to start to appear more and more in your devices like your phones and your laptops and even your iPads in the coming years. A lot of Asian companies actually assemble and make components for that. So there is a large industry which I think is on the very early days of quite a significant growth opportunity over the coming years. Number two, I would say Southeast Asia remains a very interesting market. It's very domestically driven, a young population with not a lot of debt, and a very favourable growth outlook. It's been somewhat hampered in recent years recently I should say, by the fact that the US Federal Reserve is maintaining high interest rates, and these central banks in these smaller markets in South Asia are pretty much hostage to what's going on in US policy. But once that does roll over, when inflation comes down, you'll see central banks in this part of the world start to cut rates and ease financial conditions, and growth we think will accelerate from where it is today. So a lot of really good opportunities there. And then we move to the big sort of countries, which is at an interesting phase right now. I mean, India has had a fantastic run the last couple of years, very strong corporate profit growth, strong returns to the market. Going through an election right now, should go according to plan, but we've seen some uncertainty historically or some surprises in elections in the past in India. But assuming that politics is fine, India is one of those markets which for over the long term will deliver very good returns as it has in the past. But the big market is China, and it's been through a very challenging time, geopolitically, economically. We think it's actually quite interesting today, simply because things need to change. And if that change does come through, we do see pretty substantial returns for that market.
The fund has an overweight position in China at the moment. Given the challenges that you've just mentioned, where are you seeing the key opportunities?
As you mentioned, there is challenges, and I would say the big long-term challenge is that the economic model that China has pursued now for nearly 30 years, let's call it 20 years, is at the end of its useful life. It's been a model that originally started with entry to the World Trade Organization and globalization, and then after the global financial crisis became very much a credit and investment-led model. And the problem with that is if you're trying to stimulate growth from the supply side of the economy, you end up creating too much capacity in the economy. And as a result, with excess capacity, you start to lose pricing power for companies in that market, and deflation starts to set in. And China had a skirting sort of moment with deflation 10 years ago. around 2015, and it almost ended very badly. They came out of that with some pretty constructive policy and survived that risk. But here we are again today with new industries that are creating that excess capacity and the deflationary forces. And if nothing is done, because the options on credit are pretty limited because most parts of China are now highly leveraged, if they do nothing, then you really have a risk of Japanification, let's call it, where we've had the lost couple of decades in Japan up until recently. And the market's taking this sort of wait and see approach almost to see if policy will change. Now, if it doesn't change, it's not good. A deflationary environment is bad for corporate profitability across the board. And equity returns in China are actually very closely correlated with corporate profitability, so the market will suffer if nothing changes. But the reason we're actually quite interested right now is it seems there's two real options for China. And normally it's, as you get closer to crisis, you get the change you need. And that's what happened in 2015. There is a risk that as we get through this year, that crisis may start to reappear again. The two options, I think, one is very structural, and one is kind of a response to what's going on. The structural opportunity in China, which we're starting to see some discussion around, not much action at the moment, but at least words, is social welfare reform. And particularly something called HUKO reform, which is the household registration system, which means you get things like education and healthcare in the place that you're born rather than where you work. And obviously there's a large migrant population in China, and that population feels like it needs to save because they're not getting the services they want. And also those sectors tend to be very much public, and if there was to be some privatisation opportunities there or more private players, maybe returns would improve. China's household savings rate at the moment is about 40%, which is extremely high. India at the other end is sort of low single digits, mid single digits. So that is one opportunity, and it is, I think if you do get that structural reform, China can shift away from investment to consumption as savings rates come down. And if it does, there's, the returns for the market will be very, very strong in that environment. The second thing which is starting to emerge though, which is still a possibility here, is a currency devaluation, and actually a large currency devaluation. The market's starting to talk a bit about this as an opportunity. As I said, in 2015, when they had the deflation scare, the problem with that is with deflation, you have to lower interest rates. And if you're lowering interest rates, your currency generally comes under pressure, particularly if it's relative to other currencies. And I think learning from that time, what China's doing in this deflationary sort of environment is keeping its interest rates actually quite high relative to the US. And so you're not seeing the currency pressure today that you saw last time they had deflation. The problem with that is that by keeping interest rates high in a weak economy, you end up suffocating the economy. And so there's only a certain amount of time that you can do that. Now, the reason I come back to currency devaluation is if you, let's say, look at Japan today, the yen is depreciating very, very rapidly. And Japan is its key competitor. So there is a case to make that maybe China needs a devaluation to make its industry more competitive against a yen which is depreciating because monetary policy is still ultra loose in Japan. And if it was to occur, you'd want to do a very large one, because the idea of a currency devaluation is to stimulate your economy, making your exports more competitive, create activity in the economy, and as a result you get reflationary forces come in. Now, you want to do that from a position of strength, so they're keeping the currency strong today. But as I said, the consequence if you do that for too long is you have a weak economy. So, there is a chance that China may be setting itself up for a large currency devaluation. We're seeing very large buying of gold in China and copper and other precious metals, which are all US dollar liquid assets, which is the kind of thing you probably want to do before you devalue your currency, is buy liquid US dollar assets. So, look, it's not the base case, but it's something we need to watch very closely, because the last time they came from deflation to inflation was, as I said, 10 years ago, and over the next 2 years the market doubled. So it's something to watch very closely.
So in turn, you've got an underweight position in India. What are your key concerns about India, and where are you seeing the opportunities there?
India has done extremely well, and the heart of what we believe works in Asia from an investing point of view is owning parts of Asia that do better than what the market's expecting, and avoiding markets, companies, industries that do worse from a corporate profitability point of view, and that is what we call earnings revisions. So we like to own companies and markets that we think have positive revisions, and we're underweight or avoiding companies or markets that are having negative revisions. Now, the reason I give you that backdrop is that India has done extremely well the last 3 years. Earnings expectations have ratcheted up. It's been a strong economy, it's been fully justified. And when you get strong earnings revisions, you tend to also get valuation multiple expansion. So you've had both happening in India the last 3 years. You've had great earnings revisions and you've had multiple expansion, so the returns in the market have been very strong. Now, where we are today is we have an election going on. It's only a 6-week process in India. We do expect it to go according to plan, but for the time being, what you see is government activity slows down in the short term. And interest rates are still quite high in India. So liquidity generally is tighter today. And liquidity in economies is a big driver of corporate profitability. And so with high expectations, high multiples, and a tightening of liquidity, we're just a bit worried for the short term that expectations may have got ahead of themselves. And that's when we tend to, reduce our exposure to certain markets. It's not a negative view on the long term, but more on the short term. And as I mentioned just before, around China, we are seeing more opportunities that liquidity is actually potentially loosening. And so that's we have at the start of this year, we've moved money from India to China for those reasons.
So part of the core philosophy of the fund is seeking to identify stocks with the best potential to deliver earnings surprise relative to expectation. Can you take me through your process for identifying these stocks?
The core of what we do is earnings revisions. We know that if we do it well, the experience is that it works in every country and every sector, and it's really about good execution. I mean, having good hit rate on earnings revisions. You can't actually really wait though for earnings revisions to happen because they get priced pretty quickly. And so what we do is we invest in quite a concentrated portfolio. There are thousands of companies in Asia, but we only own about 30 odd companies in the whole of the region. And these are the companies which we feel have the best potential for earnings revisions, positive earnings revisions. Now, and what I tell my team and our clients is at the start of every year, if you go back through time, the most consistent thing is that earnings change. Earnings revisions are always there. Analysts will always get their numbers wrong 12 months out. And so every day there's an opportunity for us by being smarter around where earnings revisions may lie. And it really comes from multiple sources. Some of our, where we identify potential for positive revisions can be revenue related. So it could be the product of a company we think will do better than what the market's expecting. It could be a change in sort of competitive dynamics in the industry which we think will have implications for revenue that the market's not seeing. It could also be something in the cost base where we're seeing a cost coming down or competitive pressures easing, and as a result we see lower costs. Overall, where we find revisions does vary a lot across the region, and sometimes it's influenced by macro as well. But as I said, the most consistent thing is that the revisions are out there, and the key is to have a good hit rate around this. And if you do, then the returns are there to be had.
And finally, Andrew, how can investors use your strategy within their portfolio?
Look, the way we run money in Asia is if you want exposure to Asia, we feel like we can navigate the volatility in the region. It's extremely difficult outside of Asia to understand all the nuances of every market. What we find is that a lot of the other funds in the market are very style dependent. So some are very growth orientated, some are very value orientated, some are very biased towards certain countries. But the experience through time is that leadership in the market does change. By definition, it's emerging markets and things are more volatile, and as a result, the leadership inside the market does change through time. And growth investing was fantastic from the global financial crisis up until a couple of years ago. Since then, it's been value. In the 2000s, it was more sort of value-orientated market. Sometimes it's healthcare, sometimes Indonesia. The leadership really does change through time. And I've been doing this now for 22 years, consistently with the same process. So we feel like if you want some Asian exposure, and you're worried about the volatility in the region, this fund will help you navigate that volatility and deliver consistent returns. The objective is to deliver consistent returns above the benchmark. And that's what we've been doing now for more than 20 years.
Thank you so much for taking us through the fund today, Andrew. If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.